Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
You know, when you sit down to read an SEC financial filing, there is a very specific expectation.
Oh, yeah. Usually it's pretty brutal.
Right. You expect like columns of numbers. You expect these really dense, dry legal disclaimers.
A cure for insomnia, basically.
Exactly. It reads a bit like a phone book mixed with, I don't know, a corporate tax return. Because a Form 10Q is, after all, a company's sworn testimony to the federal government.
Right, it's where marketing hype basically goes to face the accountants.
Under penalty of perjury.
Yeah, that is the mundane reality of corporate reporting. I mean, these documents are engineered for strict regulatory compliance, not for, entertainment or visionary storytelling.
But every now and then, you open up one of these PDFs, you start scrolling past the standard balance sheets, and you realize you aren't really reading a normal corporate update anymore.
No, you're looking at something else entirely.
You are looking at the blueprints for a sci-fi reality, just hiding in plain sight inside a government document. So welcome to this deep dive. Today, we are taking you inside a very specific, totally fascinating source, which is Tesla Inc.'s Form 10Q for the first quarter of 2026.
And our mission today for you, the listener, is to look far beyond just those top-line revenue numbers.
Right, because there's a lot more going on.
Exactly. When you actually parse through the legal and financial structure of this specific 10Q, it functions as a master roadmap. It reveals a company that is aggressively, almost frantically, transitioning away from being a traditional automaker.
They are attempting to morph into this sprawling artificial intelligence, robotics, and energy infrastructure behemoth.
Which is an insane pivot.
It is. Okay, let's unpack this. Because to fund a sci-fi future, you need an astronomical amount of cash in the present.
You definitely do.
I mean, the visionary stuff doesn't matter at all if you can't keep the lights on today. So let's start with the money engine, the core business.
The cars.
Right, the cars. For the first quarter of 2026, total revenue hit $22.39 billion.
Which is huge. That is a 16% jump year over year.
Yeah, and the primary force driving that surge is automotive sales, which leaped 20% to $15.47 billion.
But rather than just looking at the final dollar amount, I mean, we really need to examine the physical mechanism behind it. The filing specifically attributes this to a 10% increase in cash deliveries of vehicles.
I noticed that, and that traces back to the physical reality of their factories, right? Because in the prior periods, they had essentially stopped the assembly lines to completely retool the factories for the new Model Y.
Exactly. The operational friction of tearing down and rebuilding a factory line created a massive bottleneck in previous quarters. So what you are seeing in this Q1 report is basically the dam finally breaking.
Oh, I see.
Yeah, the factories are back fully online, all that pent-up demand is being met, and that production spike is just violently hitting the balance sheet in a very positive way.
Wow. However, while the physical cars are generating more revenue, there is a pretty severe drop in a category that used to be like their safety net.
The regulatory credits.
Yeah, that stood out to me as a massive shift. I mean, for years, selling environmental regulatory credits to other, slower moving legacy automakers was this massive, virtually pure profit lifeline for them.
Right, it was practically free money.
But in this quarter, that credit revenue just plummeted 36%, down to $380 million.
Which really tells a crucial story about the broader automotive ecosystem. Because as other manufacturers finally ramp up their own electric vehicle production to meet shifting global regulations, they just don't need to buy as many of those credits anymore.
Right, they're hitting their own quotas.
Exactly. The era of free, high-margin regulatory money is shrinking rapidly. But just as that historical crutch disappears, another category is exploding to take its place.
And it's categorized so quietly, just services and other...
It's the hidden star of the entire 10Q, honestly.
It really is. Services and others surged 42% to a staggering $3.74 billion.
It's massive.
And looking at the granular breakdown, this is being fueled by used vehicle sales, non-warranty maintenance, and perhaps most crucially paid supercharging sessions.
Yes.
Which really makes me wonder, is this them finally pulling off the classic razor and blades business model? Where the car is just the razor, like the expensive physical platform you sell them once, but the real ongoing corporate wealth comes from the blades.
The supercharging, the insurance, the constant service.
Right. Is that what we're seeing here?
I mean, you are thinking a bit too small with that analogy, actually.
Oh, really? How so?
Well, the traditional razor model assumes the blade eventually gets dull and needs physical replacement. The ecosystem being outlined in this 10Q is more akin to like a dominant software operating
I
system.
don't know, like a tech platform.
Exactly. As the global fleet of these vehicles ages and expands, that services revenue naturally compounds. Every single time a driver plugs into a supercharger or pays for an over-the-air software upgrade, they are injecting high-margin cash directly into the system.
That makes total sense. And to round out this core business picture, we also have to factor in the energy generation and storage segment.
Right, the batteries.
Yeah, which actually dipped 12% this quarter to $2.4 billion. But the 10Q seems to kind of brush that off as a logistical quirk rather than, like, a sudden drop in demand.
Yeah, they physically deployed fewer megapacks and Powerwalls during this specific 3-month window.
Right.
The timing of massive grid-scale battery deployments is always going to be pretty lumpy from quarter to quarter. But the metric that truly matters there is the profitability of what they actually did sell.
The margins.
Right. The gross margin for that energy segment improved significantly, reaching an incredibly healthy 39.5%.
Wow, almost 40% on physical energy storage.
Yeah. And when you step back and aggregate all of this, the cars, the rapidly expanding services, the highly profitable batteries, you arrive at the most vital number in the entire document.
Operating cash flow.
Exactly. The core business generated $3.94 billion in actual operating cash this quarter.
Meaning, after all the materials are bought and the factory workers are paid, they just have nearly $4 billion in fresh cash sitting in the vault.
Pure cash.
They are entirely self-funding at this point.
They are not relying on external Wall Street debt or diluting their stock to keep the lights on. That absolute financial independence is the mandatory prerequisite for the sheer scale of capital they're about to burn through.
Because they're about to burn a lot.
Oh yeah. This cash engine is what makes their next phase even possible.
Which brings us to the R&D explosion, the pivot to real-world AI. Because they are certainly not hoarding that cash. They are spending it at a blinding pace.
To put mildly.
Research and development expenses skyrocketed 38% to $1.95 billion just for the quarter. And their projected capital expenditures, like the cash they plan to spend on massive physical assets and infrastructure, is projected to exceed $25 billion for the year 2026.
I mean, $25 billion in a single year is a staggering allocation of capital. It's almost hard to wrap your head around.
It really is.
And the 10Q serves as this itemized receipt for that ambition. They are rapidly expanding Cortex.
Remind us what Cortex is again?
That is their massive on-site artificial intelligence training cluster located at Gigafactory, Texas.
Right, the supercomputer.
Yeah. And they are also expanding their manufacturing scope far beyond just bending metal for cars. They are moving into actual semiconductor fabrication.
So they are literally building the physical brains for their neural networks in-house.
Exactly.
And they are building out the infrastructure to support the robotaxi service, which the document notes officially launched back in June of 2025.
Yep.
Plus, they've begun pilot production of the new dedicated Cybercab vehicle just to supply that autonomous network.
And the sheer scale of their ambition requires acquiring capabilities they simply didn't have internally. So in April 2026, they reached an agreement to acquire an external AI hardware company for $2 billion in stock.
Yeah, just to instantly bring that proprietary architecture in-house.
Exactly.
And here's where it gets really interesting. The filing just casually details a $2 billion equity investment they made in March 2026 into SpaceX.
Yeah, that caught a lot of people off guard.
I mean, I have to push back on this. I am looking at a publicly traded car company taking $2 billion of shareholder money and funneling it into a private space exploration company in exchange for less than a 1% stake.
It looks crazy on paper.
It does. How does that make any logical business sense for someone buying Tesla stock?
Well, if you analyze them strictly as an automaker, it looks like a severe misallocation of funds. You'd be right to be confused. But the 10Q explicitly states they are preparing for a service-driven business model. That model requires full autonomy, millions of robotaxis, and eventually millions of Optimus humanoid robots.
All of which require a terrifying amount of constant low-latency computing power and data transfer, like everywhere on Earth.
Precisely. Real-world AI involves moving absolute mountains of video data and securing constant, unbreakable connectivity.
Ah, so it's about the satellites.
Exactly. By taking an equity stake in SpaceX, they are likely securing preferential access to global satellite networks like Starlink. Tesla is basically vertically integrating every possible choke point.
That is wild.
They are securing raw lithium refining in Texas. They are fabricating custom AI silicon. They are building the Cortex server farms to train the software. And they are securing space-based telemetry to connect the fleet.
They're literally building the ultimate inescapable compute engine.
They really are.
Okay, so if the company is pivoting this aggressively toward a highly risky, incredibly capital-intensive future, it begs a massive question.
Who is driving the ship?
Yeah, who is holding the steering wheel and how exactly are they being incentivized to pull this off? Because the 10Q dedicates a staggering amount of ink just to the CEO's compensation.
It really does. The CEO compensation saga documented here is arguably the most complex and legally dramatic corporate governance story in modern financial history.
It's basically a soap opera at this point.
Truly. And this specific 10Q captures several tectonic shifts. First, it details the resolution of the infamous 2018 Performance Award. The Delaware Supreme Court officially reversed a previous lower court ruling, fully reinstating that 2018 package.
And because that massive 2018 award was reinstated, the 10Q notes that a newer 2025 interim award was immediately forfeited.
Right. The board invoked the no double dip principle. You don't get paid twice for creating the same value.
Makes sense.
But the reinstatement of the 2018 award solved one legal problem and created a massive structural risk for the company itself.
How so?
Well, if the CEO were to exercise all those reinstated options at once, the resulting tax bill and exercise costs would be astronomical.
Oh.
He would likely be forced to liquidate a massive percentage of those shares on the open market just to cover his tax obligations.
And a sudden stock dump of that magnitude would absolutely crush the share price for everyday retail investors.
Exactly. Recognizing that threat, the board's special committee engineered what they call an implementation agreement.
Okay.
To protect the stock price, this agreement forces the CEO to remain in continuous service to the company, either holding the title of CEO or acting as the head of product development and operations through January 19, 2028.
Wow.
Furthermore, it imposes a strict 5-year holding period on those vested shares.
So that legally chains him to the desk. He can't just take the money and run.
Right. But that is just to settle the past.
Right, because then we get to the 2025 CEO Performance Award. And, I mean, the numbers here are genuinely hard to wrap your head around.
They're unprecedented.
It involves a potential payout of over 423 million shares. But to actually unlock them, the milestones are terrifyingly steep.
The document lays out 12 operational milestones, alongside market capitalization hurdles that scale all the way up to an $8.5 trillion market cap.
$8.5 trillion.
It's nuts.
And the operational targets are just as wild. I mean, looking at the list, they have to manufacture and deliver 20 million vehicles. They need 10 million active paying subscribers for full self-driving.
Yeah.
They have to get 1 million robo-taxis into commercial operation. They have to hit $400 billion in adjusted EBITDA over several periods.
And just for our listeners, adjusted EBITDA is essentially just the raw cash profit generated by the core business operations, right? Before the accountants start factoring in things like taxes or the depreciation of those massive factories.
Yeah, it is a pure measure of operational cash generation.
Exactly.
But out of all of those, this is the milestone that completely blows my mind. To get paid, the CEO has to oversee the delivery of 1 million Optimus humanoid bots.
1 million.
Has any corporate financial document in history ever mandated the mass production of 1 million humanoid robots as a condition for a paycheck?
Definitely not.
I mean, this isn't a normal corporate bonus structure. This is like telling your general contractor they only get their final check if they successfully colonize Mars.
That's a pretty good way to put it. The sheer audacity of the milestones is entirely without precedent. However, the underlying corporate governance logic is incredibly sound.
How do you mean?
Well, this structure is not just about enriching an executive. It is a legal mechanism designed to completely lock down the singular focus and attention of the CEO during the highest risk transition phase the company has ever faced.
Ah, so he can't get distracted.
Right. The board is aligning his potential payout exclusively with the creation of unprecedented shareholder value. But the accounting reality of that promise is pretty immediate.
Oh, yeah, I saw that.
The stock-based compensation expense recognized on the income statement for this single quarter was over $1 billion.
Over $1 billion in pure expense, just on the statistical probability that he might actually pull this off.
It's the ultimate corporate wager.
It really is. But while the compensation milestones are literally looking toward, a sci-fi horizon, the 10Q also forces us to look down at the ground. Because the reality of executing this plan is fraught with brutal, very expensive friction.
Yes. This is where the 10Q transitions from a visionary roadmap into a very grounded, impartial ledger of risk.
So let's look at the speed bumps.
Let's examine the macroeconomic environment first. The report highlights severe immediate headwinds. Under the recently enacted OBBBA legislation, which was essentially a sweeping federal budget and policy package, the lucrative tax credits for consumer electric vehicles were completely removed.
Which is huge. You strip away thousands of dollars in federal subsidies, and that directly and immediately impacts consumer demand right at the dealership lot.
Yep. Plus, you have the chaotic environment of fluctuating trade tariffs, though the 10Q does note a potential bright spot there.
Oh.
In February 2026, the U.S. Supreme Court invalidated certain tariffs that had been levied under the IEPA framework.
Right, the IEPA being the federal law that grants the executive branch emergency powers to regulate international commerce.
Exactly. Because the court struck those specific tariffs down, the 10Q cautiously notes that Tesla might actually be in line for significant retroactive refund opportunities.
Oh, wow. So they might get a bunch of money back.
Potentially. But the macro environment is really just the start. The legal proceedings detailed in this document are incredibly heavy.
Yeah, the company is currently staring down upcoming 2026 trials involving both the EEOC, that's the Federal Equal Employment Opportunity Commission, and the California Civil Rights Department.
Right.
And these agencies are alleging systemic race discrimination, a hostile work environment, and pervasive harassment at Tesla's manufacturing facilities.
And while the 10Q explicitly states that Tesla intends to vigorously defend itself in these matters, they do acknowledge the severe unpredictability of the outcomes.
Naturally.
And it is important to understand why this matters beyond just the potential financial penalties.
It's about the talent, isn't it?
Exactly. Building the ultimate AI compute engine requires recruiting and retaining the top 0.1% of engineering talent on the planet. Massive, systemic workplace culture lawsuits act as a severe operational drag.
They create intense friction in that talent acquisition process.
Absolutely.
And beyond the workplace environment, there is the product liability front. The filing provides a very detailed update on the Benavides v. Tesla case.
Right. This was a highly scrutinized trial concerning a catastrophic 2019 accident involving their autopilot technology that resulted in a fatality.
Yes.
In August of 2025, a jury in Florida reached a fascinating and incredibly expensive verdict. They found the human driver to be 67% at fault for the crash, but they assigned 33% of the fault to Tesla's software.
And because of that 33% liability, the financial damages awarded were staggering. The jury hit the company with $129 million in total compensatory damages, plus an additional $200 million in punitive damages.
Tesla filed aggressive post-trial motions to challenge the validity of that massive penalty, but in February 2026, the court denied those motions.
So what happens now?
Consequently, Tesla is now appealing the entire case up to the 11th Circuit. And you have to remember, that is just one verdict. They are simultaneously fighting ongoing class action lawsuits regarding the marketing practices and safety claims surrounding both their autopilot and full self-driving feature sets.
So what does this all mean? When you look at the $25 billion being poured into AI clusters in Texas, the contractual mandate to build 1 million humanoid robots.
Yeah.
And then you look at a jury handing down over $300 million in damages because the software was found 33% responsible for a crash. How does a company actually survive that?
It's a great question.
Like, how do you balance pushing boundary-breaking autonomous AI onto public roads while actively managing hundreds of millions of dollars in highly unpredictable legal liability?
Well, you have just articulated the fundamental tension at the heart of this entire document. Pioneering entirely new technological paradigms inevitably, and sometimes violently, clashes with our existing legal and regulatory frameworks.
Right. The laws aren't built for it yet.
Exactly. The legal system is inherently retrospective.
Yeah.
It relies on established precedent and looks backward to assign blame.
Yeah.
Tesla's stated business model is entirely prospective. They are building autonomous systems that have absolutely no legal or societal precedent.
None at all.
So the 10Q impartially lists these governmental investigations, civil suits, and shifting tariff laws, not just as standard financial disclosures, but as the very real, very expensive friction of dragging artificial intelligence out of the server farm and into the real world.
You simply cannot deploy millions of autonomous physical agents without colliding heavily with the physical, legal, and human realities of our society.
You really can't.
Which brings us full circle on this deep dive. I mean, we started with a company whose surprisingly solid physical vehicle sales and surging high-margin service revenue have funded an astonishing $44 billion war chest of cash and short-term investments.
A massive safety net.
And we watched them take that operational cash and pour it into Texan AI clusters, custom semiconductor fabrication, and private space telemetry networks.
All of it being driven by a CEO who has been legally locked in by a compensation plan that literally requires him to invent a sci-fi future just to get paid.
Exactly. And they are attempting to execute this unprecedented pivot while navigating a literal minefield of massive courtroom verdicts, shifting tariff laws, and intense federal regulatory scrutiny.
And this is exactly why this dense financial filing matters so deeply to you, the listener.
Right.
The electric car you might see sitting in traffic on your daily commute, or perhaps the one currently parked in your own driveway. That physical vehicle is the financial engine quietly funding a massive global shift toward autonomous infrastructure and robotics.
The mundane car payment is basically funding the sci-fi reality.
It really is. Which leaves us with a final fascinating question to consider.
What's that?
Well, if Tesla actually manages to navigate this intense legal and operational friction, if they achieve the milestones laid out in that 2025 compensation plan.
Which is a huge if.
A massive if.
Yeah.
But if they successfully manufacture and deploy 1 million humanoid Optimus robots, if they put 1 million robotaxis on the grid, and if they somehow reach an $8.5 trillion valuation, will we even think of them as a publicly traded automaker anymore? Or will they have transformed into something entirely new? Like an autonomous, AI-driven infrastructure company that shapes our physical world just as fundamentally as the internet shaped our digital one.
That is wild to think about. I guess the next time you see one of their cars, you really have to ask yourself, are you looking at a product from an automaker? Or are you looking at the early beta test of a sci-fi future manifesting in real time?
It really does make you look at a boring SEC document in a whole new light.